Okay, welcome everyone. This is another lecture on financial reporting. In the previous video, we talked about, IAS 1, we talked about the presentation of the financial statements. And in the previous video, if you haven't watched it, please go back and watch it to understand exactly our direction. In the previous video, I mentioned I would be solving a question. One of the things I didn't walk you through was the format for a statement of profit or loss. So let's do that real quick, then we'll jump into the question and break the question down for all of us to understand. So this is a typical format for a statement of profit or loss. You have your revenue, you have your costs, you have your gross profit. If you take your cost of sales from your revenue, you get your gross profit. Then you also have some expenses like your distribution costs, like your admin expenses. If you deduct those from your gross profit, you get your profit from operations, your profit that you're getting from your actual operations. Then you also have your finance costs. If you deduct your finance costs from your profits from operations, and add any investment income, you'd get your profit before tax. Then you can deduct your tax expense from your profit before tax to get your actual net profit. Then if you remember in the previous lecture, I talked about the fact that one of the key things that apply to the other comprehensive income is revaluation. So any gains or losses on revaluation or any gains or losses on fair value through other comprehensive income or through other comprehensive income financial assets, it all goes to other comprehensive income. So remember very, very well, anything to do with revaluation as well as fair value, these two things, very, very critical. You need to always have it at the back of your mind. So any gains or losses on revaluation or any gains on or losses on fair value through other comprehensive income financial assets. So if there are any gains or losses on fair value of financial assets, it goes directly into the other comprehensive income section. Please keep that in mind. Right? So let's jump into the question real quick. So this is the question. It says the following information has been extracted from the books of Piclet for the year to 31st March 2009. You have admin expenses, 170,000. You have interest paid, 5,000. You have called up share capital, 200,000. You have dividend, 6,000. Cash at bank and in hand, 9,000. Income tax, 10,000. Warranty provision, 90,000. You have your distribution costs, 240,000. You have your land and buildings, totaling 210,000. You have your plant and machinery, 125,000. You have your retained earnings, which I think is 270,000. You have your 10% loan notes, which is 80,000. You have your purchases, which is 470,000. You have your sales, which is 1.3 million. Inventory, which is 150,000. Trade payables, 60,000. And trade receivables, 728,000. So these are the details they've given to us. Now let's jump into the additional information to see if there's some more explanation to any of these items or transactions that occurred. So let's jump into the additional information. And also, I want you to know that we have a WhatsApp group, and this WhatsApp group, the purpose for it is to share the slides, ask any questions you have. And so please check the description box of this YouTube video or this YouTube lecture. If you go to the description box, you'll see the link to the WhatsApp group, and you can just click it to join. You can just click it to join. So that should certainly be fine. You can get all the slides. You can ask me any questions you have, because I understand that students will have questions, and I just want you to pass with ease. So the additional information, you have one, inventory at 31st March 2009 was valued at 250,000. Buildings and plant and machinery are depreciated on a straight line basis at the following rates. buildings 5%, plant and machinery 20%. There were no purchases or sales of non-current assets during the year to 31st March 2009. The depreciation charges for the year to 31st March 2009 are to be apportioned as follows: cost of sales 60%, distribution costs 20%, admin expenses 20%. Number 5, income taxes for the year to 31st March 2009 are estimated to be 135,000. Number 6, the 10% loan note was issued on 1st April 2007 and is repayable 5 years from that date. The last one is the year-end provision for warranty claims has been estimated at 75,000. Warranty costs are charged to admin expenses. So what's the requirements? Prepare Piglet statement of profit or loss for the year to 31st March 2009 and a statement of financial position as at that date. Very, very simple question. Very, very simple question. So let's try to understand this, So I'll walk you through the solution, each transaction, step by step, step by step. Again, like I said, the slides are available. I will drop the link to our WhatsApp group in the description box. If you go to the description box of this YouTube channel, where I've put in our contact details, you should see this, the link to the WhatsApp group. You can click on it, you can just join it. If you're unable to find that, you can also give us a WhatsApp message. Our WhatsApp numbers are available. You can also email us and tell us about the fact that you want to join the group, and then we will let you join. And if you have any questions at all, just feel free to ask them. On that WhatsApp group, we ask ourselves all the questions, and we make sure everyone is fine with the solution or with the answers. So that is basically what I'll say. So let's go into the solution. Let's go into the solution. Okay. So this is the solution we have here, right? First off, if you remember, when we were looking at the format of the statement of profit or loss, the first thing that came up was revenue. So what will be the revenue amount? So the revenue amount was given to us in the question. So if you go back into the question, right? If you go back into the question, you see that the revenue here was given, and this revenue is already in the question. So if you look here, you see sales. You see sales, sales, sales. If you look here, you see sales. I've marked it right here, sales, sales, which is 1.3 million. 1.3 million. So that's how come you have your you have your sales to be 1.3 million. So you see that right there. Okay. So we are all okay about that. So 1.3 million sales, right? Then if you go back to your cost of sales, which is the next thing in the profit or loss statement, your cost of sales is simply your opening inventory plus purchases minus your closing inventory. But in this question, there was a little bit twist to the cost of sales. So let's start with your opening inventory. Let's go and see where we can find the opening inventory. Opening inventory is 150,000. So let's go and find it and see exactly where this opening inventory is. So your opening inventory should be in these details. Your opening inventory should be in these details. So it should be in these details. So let's go and check and see whether we can find it, and see whether we can find it. So the opening inventory, yes, it's here. It's inventory at 1st April 2008. You see 150,000. So let me just mark it for you to see. This is This is the opening inventory. You see 150,000, 150,000, 150,000. Yes, so that's it. Opening inventory 150,000. That's it right there, right there. Okay. Then let's move on to the next thing. So we figured out opening inventory. Now let's talk about purchases. Because remember, we said that opening inventory comprises of, we said that cost of sales comprises of opening inventory plus purchases minus closing inventory. So let's move on to purchases. If you go to your purchases, you would realize that your purchases is 470,000. It's 470,000. This is it right here. This is your 470,000 purchases. So where exactly are we getting this from? Where exactly are we getting this from? Our purchases. The question should give this to us. The question should definitely give this to us. So let's understand, okay, where are we getting these purchases from? Okay, so these purchases is here, right here. Do you see? Right here. This is our purchases. And it is 470,000 right here. It's very, very easy to see. Right here, 470,000. So I hope you are following me step by step. You know, as I told you, I'll walk you through everything step by step, and you are going to understand everything, everything. Okay, so that's 470,000 right there. Then now let's move on to closing inventory. Right now, we are going to deduct closing inventory. So let's move on to our closing inventory. I just want to take my time for you to understand every single thing that's going on here. So our closing inventory here is simply, our closing inventory we are told is, our closing inventory we are told is 250,000, 250,000. So where would this closing inventory be? Where would this closing inventory be? It's usually in the additional information. And you see that right here. See, it's very, very clear. It's valued at 250K. 250K. So you see, it's getting easier and easier. 250K. 250K. But don't forget that we are told here that depreciation charges for the year to 31st March 2009 are to be apportioned as follows. You see, cost of sales as an apportionment, which is 60%. So let's focus on that first. So number 4, this additional information is going to affect our cost of sales. So 60,000, 60,000, very, very important, 60,000. 60%, sorry, 60%. So we need to find out how to do this apportionment. We need to find out how to do this apportionment. It's very, very key. Very, very key. So when you go back to our solution, you realize that this depreciation charge has been apportioned. So even before we can do this apportionment, we need to understand what our depreciation charge is. So we need to, do some form of working in accounting to come to that. We need to do some form of working. So let's go to our working. We have to open a new sheet to, do some workings. Okay. And for our workings, we have to list the different assets we have. So we have lands, we have buildings, we have plants and machinery. Now, what is the cost brought forward for each of these ones? So let's go back to the question, and we should be able to find the cost brought forward, the beginning cost balance. The beginning cost balance. So if you look here, if you look in the workings, you see that it's 110, 100, and 125. I want you to keep note of these numbers. 110, 100, and 125,000. It should be right in the question. It should be right, it should be given in the question. So you have here, let's let me show you real quick. You have here, you see 110, 100, and you have plant and machinery at cost, 125,000. So the cost balances are all here. That's why I'm circling for you. I'm circling for you to see. So if you have 110, you have 100,000, and you have 125,000. So that's your cost brought forward. Very, very simple. Very, very simple, actually. Very, very simple. Then let's move on to your other matters when it comes to the working, because you are trying to find the depreciation charge in order to be able to know how to apportion it in the cost of sales, right? So we need to know our depreciation brought forward as well. We need to know our depreciation brought forward. Now, what will be our depreciation brought forward? So the question will give us that as well. So take note of these numbers. Always remember that land is not depreciated. So that's why you see zero balance here. But the others, you have 48,000 for buildings and 75,000 for plants and machinery. So let's go back to the question and find out what exactly is happening here. Let's find out what exactly is happening. So in the question, always keep those two numbers in mind, 48,000, 75,000. In the question, you see right here, the accumulated depreciation as at 1st April 2008, 48,000. Plant and machinery, accumulated depreciation at 1st April 2008, 75,000. There you go. You have that. Land is not depreciated, so it's zero. Land is not depreciated, so it's zero. It's zero. Okay. So once you figure that out, let's go back to our workings. We are still in our working zone. Step by step, I'm taking you through. You would understand everything perfectly. Now you move on to the charge. The charge. And what do we mean by the charge? If you go to the question, you see that there was a charge, depreciation charge, which was a percentage of costs, right? So let's go and find out what exactly will be this depreciation charge. Okay, so if you go into the question, it's getting exciting right here. If you go into the question, the additional information, you see here that in note 2, you see you have these depreciation charges. For buildings, it's 5%. For plants and machinery, it is 20%. Very, very critical. Very, very critical. Very, very critical. Okay. So I hope it's getting clearer and clearer. Like I said, we have a WhatsApp group. You can always join for free, ask any questions. The slides will be available to you on the WhatsApp group. Okay, so once we figure that out, now we can do our calculations on the workings. It becomes a lot easier. So buildings was 5%, plant and machinery was 20%. So 5% of 100,000 will be how much? 5,000. 20% of 125,000 will be how much? 25,000. So that's how come you are getting these values of 5 and 25,000. So now we can calculate our carrying amount. We can calculate our carrying amount. For land, there's nothing related to depreciation. So the value will be 110, still be 110, to be the same as the cost. For buildings, you have 100,000 minus 48,000 minus 5,000 should give you 47,000. For plant and machinery, you have 125,000 minus 75,000 minus 25,000 should give you 25,000. Then you have your totals on the side, which you can basically add. So you see how the working is playing out. Very beautiful. Very, very nice here. So let's go back to our income statement again. This income statement brought this whole thing, right? It brought this whole thing. So remember that in the additional information here, we had some information around the depreciation charges for the year to 31st March 2009. Let me mark it so that you can see it. Are to be apportioned as follows. So the depreciation charges are apportioned 60% with respect to cost of sales. Okay. So what was the depreciation charge? What was the depreciation charge? So you can see it right here, 60%. What was the depreciation charge? Let's figure that out. The depreciation charge here would simply be 30,000. Will simply be 30,000. This is the depreciation charge. 30K. 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 Let me make it a lot more clearer. 30,000. You see, that's it. When you add 5 plus 25, that's your depreciation charge, 30,000. So now you can apply the 60% for cost of sales on the 30,000. So that's what we are going to do for the next stage. So if you come here into the slide, you see 60% of 30,000. Then you can quickly calculate your cost of sales. You see how very, very simple. Very, very simple. Very, very simple. And again, I would say that you can always join our WhatsApp group. We answer our questions on our lectures in there, and it should be certainly fine if you have any questions. So you have your purchases, which is 470,000. You have your opening inventory, 150,000. Closing inventory, which is 250,000. And you have the apportionment for depreciation charge, which is 60% of 30,000. Then all of that gives you 388,000. So your cost of sales number then becomes 388,000. So now we can calculate our gross profits, which is our revenue minus our cost of sales, which then becomes 912,000. 912,000. 912,000. So now let's move on to distribution. You are following the format. Let's move on to distribution. So how do we come about this distribution numbers? Distribution, how did we come about it? So let's try to find out. And it will be given to us in the question. The question always gives us the information. So let's go back to the question to see. If you look at distribution cost in the question, you would realize that it's 240,000. It's 240,000. Distribution cost here is 240,000. That's it. Do you see? 240,000. It's very, very clear. Very, very clear. But don't forget that in the additional information, they said that in this additional information, question 4 here, or note 4, sorry, the distribution cost is also apportioned. The depreciation charge is apportioned and distribution cost gets 20%. So keep that in mind. We established from our workings analysis that the depreciation charge was 30,000. It was 30,000. So if you don't remember that, let's go back to the workings slide for me to show you that. Okay, so it's right here, you see, 30,000. 30,000, it's right here, which was 5 plus 25. 5 plus 25 giving us 30,000. Okay, so now we can multiply 20% of 30,000, right? 20% of 30,000. So you see how everything is coming together. Slowly but surely, everything is coming together. So if you go here, you see 20% of 30,000. 20% of 30,000 right here. 20% of 30,000. That's the apportionment for depreciation charge. Then the 240,000 was given in the question, which I already indicated. So if you go back to the question, you should see that living is right there. So distribution costs in the question is here. You see? Distribution cost of 240,000. It's right here. Okay. So now you can add those two. And then you should get your total distribution cost number. You can add those two. So 240,000 plus 20% times 30,000 should give you 246,000. Okay. Now let's move on to administration expenses. Administration expenses. So we are going step by step. Let's move on to administration expenses. Administration expenses, if you go into the question, you see it right there. You know, you see right here. Administrative expenses is 170,000. You see, it's right here. Admin expenses, 170,000. But don't forget that, please don't forget this, that there's some apportionment when it comes to depreciation charge. So it's possible you might miss that. So if you go into the additional information, in note 4 again, we see our administration expenses, 20%. So what do we do? Similar to what we did for distribution costs. If you go back here, you find out that 170,000 plus 20% times 30,000, which is the depreciation charge. It's right here. But there's a warranty component too as well. There's a warranty component, and I didn't want you to miss that. And this is the warranty component, which is 15,000. So let's go and find out what this warranty component is all about. What is this warranty component all about? So let's see where this warranty is coming from. The warranty is very, very simple. The warranty component is very, very simple. You can easily get this by, first of all, you have your warranty provision here, which is 90,000, right? You can see clearly there, you have your warranty provision here, which is 90,000, this value. Also, so keep this number in mind, 90,000, keep it in mind. Then also, if you go into your additional information, it says the year-end provision for warranty claims, note 7. Says the year-end claims for the year-end provision for warranty claims has been estimated at 75,000. So what you need to do is you take the 90,000 and you deduct 75,000 from it, and that would give you 15,000. So you take your 90, 90 minus 75 minus your 75,000 should give you 15,000. Basically, it should give you 15,000. And then you have to reduce your administration expense balance by this 15,000. So you deduct that. From, it will reduce your administrative expense balance. Why? Because you over-provided. The provision was higher. The provision was 90,000. The year-end balance was 75,000. So it means that you over-provided. Once you over-provided, then you must deduct from the administrative expense balance to come to the normal, to the actual balance, what the actual balance is, because you over-provided. Keep that in mind. Under-provide, the situation would be quite different. But here your provision was higher than the actual balance at year end, so you have to do that. So if you do all your calculations, your administrative expenses will come to 161,000. Very, very simple here. 161,000. So it's getting, pretty nice as we move along. So then you can calculate your profits from operations. Your profits from operations will then be 505,000. 505,000. Very, very simple. 505,000. So your profits from operations will be your gross profits minus your distribution expense minus your administrative expense, which will give us 505,000. Now let's move on to finance costs. If you go to the finance cost, you see here that it says that your finance cost is 10% of 80,000. So where are they getting these values from? Let's jump into the question real quick, because the question always gives us the information. So if you realize there, you see, it's very, very clear. The finance cost, which is your interest, is right here. Right here. See, 10% loan notes issued in 2007, 80,000. So you just have to multiply 10% by 80,000 to get your interest expense of 8,000. Very, very simple. Very, very simple. So if you come to this slide, which is our solution, you have 80,000 times 10% should give you 8,000. And now you can calculate your profit before tax, which would be 505,000 minus 8,000, which will give us 497,000. After you've calculated that, you can move on to your income tax. Now, your income tax is 145,000 in total. But how are we getting this? Let's go to the question. Let's go to the question. In the question, you'd see income tax. There's a remaining balance from the previous year. So income tax remaining balance from the previous year is 10,000. 10 is 10,000. Do you see? Very, very important. Very, very important. Then what would the other components of income tax be? Let's check the additional information. Probably might be there. Let's check the other additional information. So you see it's in note 5. It's in note 5 right here. It's in note 5 right here. Income tax for the year is 135,000. So you add 10,000 to 135,000, you get 145,000. So that's how come you are getting that 145,000. So you deduct this income tax expense from your profit before tax, and you should get your net profits for 352,000. So that's it about the income statement. Very, very simple. Again, like I said, we have a WhatsApp group. If you have any questions, we drop the slides there. If you have any questions, you can ask. It's absolutely free. All you need to do is, because I post my lectures on YouTube, you just need to hit the subscribe button, engage the notification bell, hit the notification bell, so that anytime I post a video, you should be able to get it. You should be able to get it. Now let's move on to the statement of financial position, right? You have non-current assets. You start with you have your non-current assets, which is property, plant, and equipment, right? So where do we find that? You can easily find that in our workings that we were doing. Our property, plant, and equipment should be, so when we say property, plant, and equipment, we mean land, buildings, and plant and machineries all combined. So based on our calculations we did, this is the value, 182,000. 182,000. So it's set for us right here, clearly. So we go back to it, you see 182,000 right here. 182,000. Then let's move on to our current assets, right? Let's move on to our current assets. We have inventory of 250,000, receivables of 728, and bank of 9,000. Okay. So where are we getting our inventories, receivables, and bank from? So where do we get our inventory? Our inventory from? So our inventory should be, we have an inventory of 250K. We have an inventory of 250K. And remember, this is the balance sheet. So it is the closing inventory that we would be using here in the balance sheet. So it should be somewhere in the additional information. It should be somewhere in the additional information, or it should be somewhere in the question, somewhere. It should be somewhere in the question. So yes, in note 1, you see right here, 250,000, 250K. Inventory at 31st March 2009. So this is the closing. Is the closing. Is the closing, because you are preparing the profit or loss and the statement of financial position as at 2009. So that's the closing balance. That's the closing balance. Then where do we get our receivable balance? Our receivables. Our receivables, which we indicated here. You see, receivables is 728,000. Where do we get this value from? Receivables. Receivables should be in the question, and then it's right here. This is our receivable balance, is 728,000. Very, very clean and clear. Very, very clean and clear. Then you also have your bank balance. Where will our bank balance be? This is where our money is. This is where our money is. Our bank balance should be here. Let's go back real quick. Our bank balance was supposed to be 9,000. So if you check here, you see that cash at bank and in hand. Cash at bank and in hand. Cash at bank and in hand. See right here, you see 9,000. So you see you have it all figured out, all sorted. 9,000. Okay. So let's go back to our statement of financial position. You have 250,000. Remember, the inventory is the closing inventory. Receivable 728, bank 9,000. If you add everything, you get 987,000. 987,000. If you add it to your non-current assets balance, which you get from your workings, you get 1,169,000, which is 1.169,000. Then let's move on to your share capital. Your share capital. Your share capital. Your share capital should be given in the question. It should be pretty straightforward. Your share capital should be pretty straightforward. So I think when we are reading the question, we saw that our share called up share capital. You see, right here is our share capital. So how much will it be? 200,000. 200,000. Very, very simple. Very, very simple. 200,000. If you go back again to our statement of financial position, you need to figure out the retained earnings balance. But we need to do some workings here when it comes to retained earnings. So retained earnings, let's go and check retained earnings. We need to do a little bit of workings. Yeah. So what will be our retained earnings, the beginning balance for our retained earnings? We need to have our retained earnings beginning balance. Then we can add any profits and deduct any dividends. Then we come to our ending balance for retained earnings. So our beginning retained earnings balance should be, it should be in the question as well. Beginning retained earning balance, it should be in the question as well. I believe the beginning retained earning balance is given here. So you see 270K, 270,000, 270,000, 270,000. So if you go back to the workings, you should see that 270,000 right there. See, beginning 270,000. Then what will be the profits for the year? The profits for the year, we already calculated it in the statement of profit or loss. It was 352,000. So it's 352,000. So you pick this profits for the year value and you add it to your beginning balance for retained earnings. Then now you go and deduct any dividends. So where will we find these dividends? Should be in the question too. So you go into your dividends, you go into your dividends balance. Your dividends, you try and find dividends in the question. You try and find dividends in the question. And dividends should be pretty straightforward to find. Should be pretty straightforward to find. See, it's right here. It's given to us. It's It's always given to us. This is your dividend. You see? And what's the value? 6,000. So you deduct this 6,000. You deduct this 6,000. Always keep that in mind. So beginning balance of retained earnings, you add profits and you deduct dividends. So if you go to the working again, you'd see 270,000 plus profit for the year, 352,000 plus a dividend minus a dividend of 6,000. Minus a dividend of 6,000. Then you get an ending retained balance of 616,000. Now, if you look at the dividend again, maybe in case you just missed it, the dividend is right here, 6,000. 6,000. It's here, 6,000. This is the dividend right here. Okay. So your closing retained earnings balance should give you 616,000. So that's it here, 616K. 616,000. Very, very simple. Okay, so once we have the 616,000, we can go back into the statement of financial position and put that in there. Just drop that in there. Okay. So you have your 616,000. So you see it right here. 616,000 right here. Then you need to add your 200,000 to your 616,000. Then you get 816. You get 816,000. Okay, when we've dealt with the equity side of things, now we can move to the liability side of things. Now we have a non-current liability. We have a loan of 80,000. We have a loan of 80,000. We have a loan of 80,000. So where exactly can we find it? It's in the question. It's in the question. So it's given to us clearly. This is the loan. This is the loan, 80,000. Here, right here. Right here. $80,000. 10% loan notes, 80,000. So you have it right there. And then everything else should be pretty straightforward. So if you go back into your statement of fund, you have your loan, 80,000. You have your warranties. Your warranties, which is your 90,000, which was in the trial balance, minus the 15,000, which we calculated in the income statement. So let's first of all figure out the 90,000. The 90,000 is in the question. The 90,000 is in the question. Very, very simple. This is your warranty provision. Yeah, it's 90,000, right? 90,000. Then we need to do a little bit of adjustment. We need to do a little bit of adjustment. So where would this adjustment come from? Yeah. Remember that we did some calculation when it came to this warranty, right? So now this warranty is 15,000. So we have our 90,000. We need to deduct 15,000, which will come to 75,000, right? So come to 75,000. So that's what we see here. 75,000, you see? That's what we see here. 90 minus 15,000. 90 minus 15,000, 75,000. If you realize this 75,000 is the same as the 75,000 is the same as this balance here in note 7. It's the same as this 75,000 here. It's the same as this 75,000. So you have 75,000, right? You have 75,000 right here. So now you can add the loan, which is 80,000 to 75,000, and you can get 155,000. Now let's move on to some more liabilities with payables. You have payables here. You have payables. What will be our payable balance? And is there any accrued interest? So let's go and check. What will be our payable balance? It's getting interesting and I'm getting excited. You are nearing the end. So this is the trade payables, right? Do you see? And the payable balance is 60,000. But we need to ask ourselves, is there going to be any accrued interest? That might probably be in the additional information. So let's go and check and see. It probably might be there, and it's also possible that it won't be there. So we need to check exactly where we can find this accrued interest. This accrued interest. So the accrued interest, as I already indicated in our solution, should be here. Let me just show it to you real quick. Our accrued interest should be here. It should be. Let me show it to you. Let me go back to the question real quick. So we have our accrued interest. We have our accrued interest to be 3,000. And how do we get that 3,000? It's very, very simple. You have your 10%. I was trying to get to the right place so that we can all discuss it. Remember that the interest expense, remember, was 10% of 80,000. 10%, 10% of 80K, which will give you what? 8,000. That was the interest expense. So keep that number in mind, 8,000. And that's what went into our income statement. So keep that number in mind. Now, if you come to the trial balance, you see here that we have an interest paid here of 5,000. Let me draw it so that it looks 5,000. So now you take the 8,000 and you deduct 5,000 from what do you get? It's clear, right? You get 8 minus 5 is 3. So you now add this accrued interest to the trade payable balance of 60,000 that we see here. So it's 60 plus 8 minus 5. It will give you 63,000 or 60,000 trade payable balance on one side, and our accrued interest will be 8,000 minus 5,000. How did we get the 8,000? We got the 8,000 by multiplying 10% of the loan balance, which is 80,000, gives us 8,000. Then we have some interest paid, which is 5,000. You deduct that, you get 3,000. You add that to the trade payable balance of 60,000. That's 63,000. Very, very simple. Very, very simple. Very, very simple. Very, very simple. Let's look at this very critically. Very, very simple. So we are nearing the end. I'm sure you're excited. Then you have your tax liability. Your tax liability is 135,000. Your tax liability is 135,000. Your tax liability is 135,000, which you see here, right here, in note 5, 135. This is the balance sheet. So we are looking at the year-end balance, the year-end balance. We did something different when it came to the income statement. The income statement, we added 135 to 10,000, right? 135 to 10,000, if you see right here, if you check right here. Just want to show you this real quick. For the income statement, we had to add 135,000, which was the tax balance as at the year end, to the remaining balance from the previous year, but we won't do that for the balance sheet. The balance sheet, we're only focusing on the year-end balance. That's it. So remember the balance assets. So the balance sheet looks at things assets. The income statement looks at things for the year ended. So 135,000, very, very simple. Very, very simple. We have that given to us right here in note 5, as already indicated. Income taxes for the year to 31st March are estimated to be 135,000. Quite simple. So you go back here and see that the tax liability is 135,000. So you add 63 to 135, you have 198,000. You add 198 to 155,000, which is the non-current liabilities, and you have a total of 1169. So you see, it balances. It balances nicely for us. It balances nicely for us. So basically, this is a simple question that I thought I would use to help you understand, the financial statement. This is a very comprehensive question. So you can definitely go through again and try to watch the video, and go through step by step. And you should be definitely fine. You should be definitely fine. So first of all, I want to say is that you can join our WhatsApp group. Our WhatsApp group is in the description box of this YouTube channel. You can just go there and go and find it. Otherwise, you can email us, you can DM us on Instagram, you can send us a message on Facebook to join. Whatever way, you can also email us. All our details are in the description box. You can just find our details and email us, or whatever means, or WhatsApp us. Our number too is available. And you can join our WhatsApp group. If you have any questions, you can just ask. And the slides are also shared on the WhatsApp group. The slides are shared on the WhatsApp group. So just subscribe to this channel. I'll be posting all the lectures you need, and be walking you through step by step on how to pass your financial reporting exam. You should be definitely fine as you follow these lectures. And I want you to hit the notification bell so that anytime I post a lecture, you'll be the first to see it, so that you don't delay in terms of your learning. So thank you very much and have a good day.